Well, Clem Santa, in association with Chantel Ilbury, have been building scenarios for both the South African and global economies for at least a decade. Their scenarios aim to shine a light on potential outcomes, and tonight we'll be looking at what these are for the global economy. We'll also be looking at investment strategies which naturally stem from these. Good evening, gentlemen. Clem, great to have you with us on World Quiz. So just remind us, what are the characteristics of a fox and characteristics of a hedgehog?
Well, there was a Greek poet called Archilochus who in 650 BC said the hedgehog knows one big thing, whereas the fox knows many little things. And most management theory is being built around the hedgehog, that you should have a vision, which is the hedgehog big idea, and then align everybody to the vision. And we feel, particularly in these very volatile and uncertain times, you have to have the foxes who do not subscribe to a single idea, who are constantly juggling different ideas and different possibilities for the future, which we call scenarios. They're looking for the flags which would suggest you're moving from one scenario to another. And then based on whether the flags are up or down, they give different probabilities to the different scenarios. And then, of course, based on those probabilities, they make a judgment about their assets or about what they should do with their business. That's how a fox works, and I just feel in these highly uncertain times, you've got to have the foxes around. So,
of course, there's a process of scenario planning we're talking about tonight. We're looking at various scenarios and how you should invest your money in light of them and the probabilities. Just remind us, the type of flags you use to look at, whether one scenario is going to play out versus another.
Well, in late 2006, we had an index in America that measures property values, the Case-Shiller index, as a flag, that if it suddenly topped out and went down, that would indicate that America might be going into recession, since a house is the principal asset to most American consumers. And with house prices coming down, they'd spend less, which would trigger a recession in America, which would trigger a recession in the world. At the beginning of 2007, it started falling, and it fell for 6 months. So in June 2007, we were giving a 50% probability to hard times, even though the markets were still going up. That's what a flag does.
And there we go. So, in the context of today, we're going to be looking at the type of flags you should be looking out for. But Quibby, take us through the fox mapping scenario planning we're looking at today.
Well, okay, before I get there, I think maybe what's the important thing is for Clem just to explain maybe a little bit around what the hard time scenario is. Again, just for you as a viewer at home, there are 4 basic scenarios from a global perspective that Clem Santa and Chantel Ilbury has been working through. Clem, maybe just take us through the hard time scenario very briefly.
Yeah. I mean, we have a matrix which is built around whether we're living in a world where globalization will continue to be a unifying force, or whether we're in a divided world, whether economic growth is going to recover, or whether we're going to remain pretty flat and low. And the first scenario we offer in that matrix is hard times. It's a flat universe, possibly for 10 to 15 years. It's the exact opposite of what we had between 1982 and 2007, which was a long boom. The latter half of the boom was fueled by credit, and hard times is just the hangover period when we have to pay off that credit, governments, individuals and companies. But attached to that, the demographics of some of the principal economies are simply not good for growth. Japan's had a flat period for the last 23 years because it's an aging society. Europe is actually even worse than Japan. In fact, Italy has a declining population. So, you've got 2 really big economies that are aging. America's okay, their 35 to 45 age group is still growing, and they've still got generous policy on immigration. But overall, it's a credible scenario to have a flat, low growth global economy for at least 10 to 15 years.
Is that from where we are now, or is that are we 5 years into that already?
Yeah, people would argue that we were probably 5 years into that already. And in fact, the indices, if you look at 2000, like the Standard & Poor's, then and now, it's flat. So yeah, we've already had part of the flatness.
Let's have a look maybe at some of the graphs around some of what Clem has been explaining. If you have a look at your screen, you'll see a traditional approach as far as asset allocation is concerned. This assumes that if you're a young individual, you should own a lot of equities, and as you become older, well, quite frankly, you should own less and less of your growth asset classes and more of kind of the yield-based asset classes. Well, none of this really takes scenarios into consideration, or potentially the scenario that we're looking at the moment, which is the hard time scenario. Clem speaks about Japan as being kind of the one of the great examples as far as kind of an aging population is concerned. And I want you to look at this over here. This shows you United Nations. It shows you some data that they've run on the Japanese economy. These are males that you can see on this side of the graph and females on the other side of the graph. And it just kind of shows you young people at the bottom end of the spectrum, and as people become older, as it moves up the spectrum, you can kind of see why this has got a population problem. Look at what it looks like by the time it gets to 2020. You can just see that kind of the population pyramid has become an inverted pyramid, which looks more like a funnel at the end of the day, which kind of from a demographic perspective kind of means that there's kind of big problems ahead for them. Not surprisingly, if you look at the Japanese market, and if you look at your screen now, you'll see the Japanese market. You'll see that it peaked in 1988 and all the way down to where it is over now. You can see that you've made absolutely no money. As a matter of fact, if you got the crash perfectly right, you still would have made no money. Total price to earnings ratio for the market at the moment is about a 10 PE. And if you want to see some of the big cappers in that market, there you can see them. You can see the dividend yields for some of the big kind of companies in the spectrum versus the price to earnings ratio. It's interesting to see that Nissan Motor Corporation kind of sits right at the bottom over there. Yep. And that's kind of a business which kind of long term kind of has become very export focused rather than kind of looking at an import market. If you had to say to me what is important, well, I'd probably say to you that the price to earnings ratios are kind of important when even in a hard time scenario. I'm showing you the South African market over here, and the 5-year corresponding real return for a starting price to earnings ratio. And you can see that if you bought cheap businesses, your average returns are actually quite nice and elevated on a 5-year real basis. But as you kind of elevate on a PE scale, kind of just over time, you could just see how your returns just kind of become less and less and less over time.
So basically what this graph is showing is you buy an expensive share, the likelihood of making any money over this period of time diminishes the more expensive the share is, basically.
And you know what's uncanny is that it holds globally as well.
Yeah.
So it's not just something which happens locally, but it happens globally as well. So if you're going to be in a situation where you're going to be buying if you're going to be buying in a hard time scenario, I think Clem puts it quite aptly, but he says, be a dog whisperer as far as that's concerned. Understand when to buy cheap companies. Just look quickly at the asset allocation that we're putting forward for a hard time scenario. Lots of cash, some bonds, a little bit of local equities, and a little bit of global equities. Trying to spend into the cycle as far as your cash and your bond holdings are concerned.
Explain this to us, having a huge kind of less risky portfolio.
Yeah, I mean, the most important thing to understand in hard times is that, and that's why we talk about real dogs and apparent dogs, strategy is so important. If you have an intelligent strategy, you can grow your business in hard times because it's hard times for everybody. If you have an unintelligent strategy, in the 1990s, you just grew slower than your competitors. Now you die. Mm-hmm. Simple as that. And so you've got to be very careful, particularly with high PE stocks, that they're not actually putting in place a strategy that their competitors are going to completely wreck. And yes, then you will have a serious disaster on your hands.
I mean, Roland, you spend a lot of time looking at getting the asset allocation right within various scenarios. What are your thoughts on this kind of scenario within a hard times probability?
Well, the thing that's always the next level of a challenge is to take the economic scenario and drill that down into some kind of earnings implication for the market. And maybe I can ask Clem a question on this is, let's maybe break down hard times into two types of hard times. You get obviously low economic growth, which is a pretty tough time, right? But within a low economic environment, you can have low inflation, which is sort of a lack of demand kind of thing, and then you can get a high inflation scenario with low economic growth. Just paint maybe the picture in terms of the US, Japan, where they are in that kind of cycle, because there is a bit of a fear now that we're going to have with high commodity prices, rising inflation, which is a different type of hard time than a slow growth environment. Yeah,
I must say the Japanese parallel for me is probably where it's at. So we're not actually going to see huge inflation rates in the hard time scenario, because it's a scenario where demand has dampened, and commodity prices will, they'll remain fairly solid, but they're certainly not going to go through the roof like they would in a recovery scenario.
So like the EU with its austerity measures is forcing the demand to be flat. In other words, inflation is not going to, and that obviously has a spillover to the exporting countries, China and Japan, which is going to procrastinate that, right? How do you get out of it?
Well, we're basically saying it's hard times for everybody. It's not just hard times for Europe, Japan and America. It means that China's economic growth rate will be fairly modest in that scenario.
Maybe it's worthwhile to maybe look at the second scenario and maybe just kind of run through some basics there. Clem, take us through the second scenario as far as your scenarios are concerned.
Yeah, it's called ultraviolet. It's a two-speed world. It's where the old world economies, Japan, Europe, America, have this very flat period for maybe 10 to 15 years. But the new world economies, China, India, Africa, South America, manage to grow at least 3 times faster than the old world economies. And in that scenario, it's the companies that chase the V in the emerging economies that are going to do well. And our principal flag between hard times for everybody and ultraviolet is China. If China continues to grow at 8 to 10% per annum, then all the countries supplying China will do well. But if China has the kind of wobble that Japan had in the late 80s, then of course it's hard times for everybody. And I have to say we've gone more negative on China. One, because 38% of China's GDP is exported to the rest of the world, and exporting into a flat Europe is not good for China. And secondly, there's a lot of empty property in tier 2 cities outside of Shanghai and Beijing, where whole suburbs are empty, and this could have exactly the same impact that the property bubble had in Japan, that next year you're going to see a dive in property prices, and that will impact the banking system.
Let's maybe look at some of the graphs as far as the ultraviolet scenario is concerned. Just have a look at the population pyramid as far as the United States is concerned, and you can see how different that looks to Japan that we looked at a little bit earlier. There's 2010, there's 2020. You can see that the Americans look fundamentally different to Japan. But look at another rich country, there's Spain, and you can just see how fundamentally different Spain looks. And you can see they really do have a demographic problem as far as a longevity for their GDP growth is concerned.
Just explain that to us. What is the problem in Spain when it comes to demographics right now and the age of the population?
The problem is that, if the 35 to 45 age group are the ones that really spend. And if you've got a graph like that, it shows firstly that that particular group is declining in numbers, and declining in numbers is not good for an economy. But the second thing is you're going to have a huge hike in the dependency ratio, where a limited number of young people are going to be looking after huge numbers of old people, and so the dependency ratio is going through the roof. And in fact, as you'll see, China is going to run into that problem with its one-child policy further down the line, where its dependency ratio
But Spain has also got an interesting problem where the bulk of the population is the spending power is also where you have most unemployment at the moment. 1 in 4 people, I believe, is unemployed in that critical kind of area.
Yeah, because the demographics have already kicked in. They've kicked in Spain, they've kicked in Italy as well. That they're
got nothing to do with the European crisis, it's just the nature of the population.
Well, one of the greatest scenario planners ever was Pierre Wack. He was a Frenchman, and he said, when you look at a country's prospects, look at its demographics. And I haven't made the point that because we're slightly negative on China, we give a 40% probability to hard times and a 30% to ultraviolet. So they're like two favourites running side by side in a horse race, and obviously we're going to watch every single flag and piece of information on China to decide which one is ahead of which in the race.
It kind of begs the question, what do you do in a situation such as that, and how do you invest? Just have a look again at the screenshot of the largest American corporations, and there you can see the price to earnings ratios again for those relative to the dividend yields for some of those corporations. And you can see that you can quite easily be a dog whisperer still in the American when you look at American corporations. Look at some of the big oil players down over here. If you just have a look at those, you can see single-digit PEs and fairly high and decent dividend yields as far as those are concerned. So if you were a UV Fox, how would you be investing? Well, again, and it's quite interesting that you again own local equities, you own global equities, a little bit of global property, because if there's going to be growth in G7, and there's going to be growth in emerging markets, well, guess what? Property is probably going to do quite well in both those areas. So you don't have to worry about pinpointing it so much. But again, and it's got this as a common theme with hard times, you're sitting with a lot of cash and bonds still. And over here, maybe corporate bonds or very short-dated bonds, where you could literally spend back into the equity cycle, depending on, because remember, and I mean, Roland, give us your opinion here, but when you've got a UV world, it's a start-stop type world where growth doesn't happen just kind of, as a continuum. And that obviously is, quite tough, as far as your valuations
well, it'll be fragmented. There'll be certain sectors that do well. I mean, one of the questions maybe is, are the UV kind of economies the ones that rely on domestic demand more than the hard times, which is more of a global kind of contagion effect, whereas UV is more opportunistic in terms of the countries where there's high population growth and some economic growth, emerging markets, you get a better return. Is that?
Yeah, well, the way you hit the UV scenario from an investment point of view is you either invest in the UV markets, i.e. China, or African countries, or South American countries, or you invest in multinationals from Europe and America that market heavily into those economies. And I have to say, most American companies are now chasing the V in Africa big time.
Well, let's hit pause on this conversation because we've run through the two most important scenarios, but we've got two more to get through. And then, of course, we'll take a look at what a Fox should be doing with all this information when it comes to investment strategies. We'll see you after this very quick break. More with our guest, Clem Santa, after 2 minutes. Do stay tuned.